So today's lecture is going to be about moving averages. We're going to talk about simple moving averages, crossovers, and exponential moving averages. So why use moving averages? The first reason is to smooth erratic data and to show trends. And this gives you a better idea of where the trend is going. The second reason to use moving averages is to find levels of support and resistance. And the final reason is to find price extremes. So the first type of moving average is the simple moving average, which essentially gives an equal weight to every single period. So if you have the 20 moving average, it's essentially calculated by taking the closing price of the last 20 days and doing an average of that. Now, there are a few advantages and disadvantages to simple moving averages. One of the disadvantages is that it gives equal weight to every single period. Sometimes a very big move might only occur at the end of the 20 period. Now, even though that might be a big move, seeing as your weighting is equal, your SMA is not going to be very reactive. Now, this could be modified on a case-by-case basis, but that really depends on you and what your purpose is when you are using these SMAs. Now, I mentioned the 20 SMA, but you can also have the 50-day SMA, the 200-day SMA. In this case, the 50-day SMA is the fast SMA, and the 200-day is the slow SMA. The more periods you include into your SMA, the slower it is going to be to change its direction. But also, the more reliable it is, if you think about it, because it means that more periods are going into that change. Whereas if you are looking at a shorter SMA, they tend to move a lot faster, and they also have a lot more changes in direction. With shorter SMAs in length, unfortunately, you have a higher likelihood of getting false signals, seeing as it takes a smaller amount of periods in that calculation. Now, a popular concept in technical analysis is the crossover. And what does that mean? It means when one SMA, a slow SMA, crosses with a fast SMA. And a crossover essentially represents a signal that we are having a change in trend. Now, these signals, these crosses often happen very late in the trend, but they are indicators of increasing momentum. And relative to the reversal point, these signals are a lot more reliable. Now, it just happens to be that crossover points often occur at support and resistance levels. If we see a cross up, we called it a golden cross. And if we see a cross down, we call it the cross of death. And the golden cross and the cross of death, that's talking about the SPY, in other words, the S&P 500, on the 100 versus 200 SMA. And the last thing I want to mention about crossovers is that they're not very useful if the market is non-trending. In sideways markets, you can get a lot of false signals. As with many things in technical analysis, what I recommend personally is playing around with the SMA, changing the periods in order to get the best possible signals for your stock specifically. Because the truth is that every stock acts differently, that the levels of volatility are different, the levels of liquidity are different, and so it goes pretty much on a case-by-case basis. However, if done well, it could give very reliable results. So the next one I want to talk about very briefly is the EMA, which is the abbreviation for the exponential moving average. So it acts in a very similar way to the SMA, except that it gives more weight to recent data, and thus may remove some biases where you might be putting too much weight on past and less relevant data. Now, before I end up the video, I just want to mention that moving averages are great tools to determine trends. If the price that you are looking at is currently above the moving average, that means that you are in an upward trend. That means that the current stock price is above the average of the past, say 20 or 100 periods, and that you're in an upward trend. Also, a quick reminder, moving averages can be used as support and resistance levels. They are great tools to be used, especially when coupled with other indicators like the RSI, for instance. So there you go. That pretty much wraps up my video on moving averages. Stay tuned for the next one if you want to hear about envelopes, bands, channels, and Bollinger Bands. Thank you so much for watching. I'll see you in the next one.